somewhere else and you're representing yourself in Austin on stage at some big pitch event, we'll help you get ready for that. We don't care if you're a member here or anything like that. It's open to everybody. The third Tuesday, which is probably our most popular session, is the intro to the Austin startup scene. That's for anybody that's new to Austin or new to the startup scene and wants to plug into what's happening here. We do happy hour every month after that for people that are new to Austin. And then there are a lot of other events happening here all the time. As you probably see, there's a dozen events happening here every day. I think we already went through that one. So, okay, so what's so special about Austin while we're all here? Well, Austin is totally kicking ass. Seems like everywhere you look when they make a top 10 list, Austin's at the top of the top 10 list. Last year was the #1 place in the U.S. to start a new business. Kauffman Foundation actually just released a new report. We are officially now #2. Austin and Miami are like swapping turns, but basically for the past 3 years we've been #1 or #2 ranked for our startup activity for our entrepreneurial ecosystem here. And in general, things just seem to be getting better and better. They seem to be having more startups, more companies here, more people moving here, all these other things that help to make it better. And so what's different about Austin is really a question of almost like what's different about Silicon Valley, because actually most of the things that are different about here in Austin are different about all the places that aren't Silicon Valley. And so when you travel around and go to other cities like Chicago or DC or much smaller communities, you're going to hear them complain about a lot of the same things that we complain about here and have a lot of the same types of challenges of being in a place that's not in Silicon Valley. So we're going to say it's what's different about Austin, but it tends to be what's different about everywhere else. So specifically, this blog post about how to raise $500,000 goes through 5 different points, and I'm going to talk through them just a little bit, and obviously you can read the blog post to get a little bit more. But these are these 5 things of what it takes to go raise that first round of funding. And they somewhat build on each other. If the first one, which is all of the team, is strong enough, then none of the others matter. So if you are a serial entrepreneur and you've built a couple companies before and one of them went public, then probably no matter what you're going to go do, people are going to invest in you and give you money to go do that. That's about all you need to have is that kind of history and background. But most of you are probably here because you probably don't have that. And most of the people I talk to don't have that thing behind them. But in the end, the team is still one of the most important things at this early stage. And certainly as we're investing, that's what we're looking at. Because when at this early stage, it's all about people. Everything else is going to change. Whatever you think your business is, it's probably going to change. The environment's going to change. The market's going to change. All kinds of, you're going to learn a ton of different things. The people are going to probably change a little bit too, but the people are the thing that's going to be the most the same, and that's what you're really betting on, the people that are going to go run it. And so ideally, you want to think about like what stands out about your team and what makes you the right people to go do this thing you want to go do. And so typically that's going to start with you being really passionate about it and you having some expertise about it. Usually to innovate on something, you have to know a lot about something. There are a few exceptions like with Bill Gates and Mark Zuckerberg, but most of the time when people come up with something really innovative and disruptive, they're actually experts at it first and they know a lot about it. So do you have people that know a lot about the thing you're trying to go do? Have they done things like this before? Do they have some kind of pedigree or other kind of external acknowledgement that's going to make them stand out to investors? Like they went to some really prestigious school or they worked at Google or at Amazon or some other place like that. But you have to think about what it is about your team. And interestingly enough, of all the things on this list, the easiest thing to improve, you may not feel this way at first, but the easiest way to improve your company and the easiest way to upgrade what you're doing is to upgrade the team, to get somebody else to join your team. And when a company that I see is struggling and they're having trouble kind of getting traction or with investors or other things, one of the most immediate things that just turns everything around is they added some amazing person to the team, and suddenly everything's different. Suddenly it's way easier to go raise money. Suddenly there are all kinds of doors open for them, and a lot of other things happen. And it's usually much actually easier to get somebody great to join your team than you might think. A lot of times your perspective is like, oh, I'm a tiny little startup. Why would anybody come join my team from some really big company? But actually it sucks to work at really big companies. Many of them think it'd be awesome to come work at some startup, and if you're doing something really great, you can go do that. So that's the first thing is it's about your team, and so you don't want to forget that and really think that you're selling yourself and your team and the people that have to believe in you and want to work with you. Another thing, and this is a pretty basic thing, I don't personally get too hung up on this, but you do have to understand what it is you're trying to go do and what the market is, and it has to be a big enough market to support raising venture capital. There are lots of businesses that could be a great business, but might not be good businesses for raising funding. And that part of that is you have to be in a big enough market. And so if people are if you're going to go raise hundreds of thousands of dollars or millions of dollars in funding, in order to do that, you have to, if you're presuming that you're worth more than that, that you're going to be worth tens of millions of dollars, and investors putting in are hoping that you're going to be worth hundreds of millions of dollars, and so they have to see how that could be possible. And so that is a market analysis. That's looking at like how big is this space, and what are the big companies in that space, and are they companies that could afford to spend a lot of money to buy another company, or is this business big enough to go public? And the kind of generic number for that is $1 billion market. It's saying like, you know, if the market's not at least $1 billion in size, then assuming you're going to get some percentage of that market, then there's, you know, enough room for you to make a business that's doing more than $100 million in revenue. $100 million in revenue is, again, somewhat arbitrary, but that's about the threshold for going public. And so that kind of becomes this number for like you built a big successful business. And obviously, you can do much bigger businesses than that too. But that's one thing a lot of investors are going to look at. If they look at your business and they say this is too small, it's not going to be a big business, and that would be a reason that they wouldn't invest. Now, one thing I will say is a lot of the best businesses create new markets. They open up the market to people that wouldn't be able to get access to it before. They make the market bigger. And so like ride sharing does that. Like I didn't take taxis before ride sharing came along. But now I take ride sharing. And so the market got bigger. I wasn't in the market before, but I am now because the product is accessible to me in a big way. So really exciting things, and really great investors see the possibility of creating the market bigger too. But that's something you have to be able to see and articulate. Traction is super, super important. So what have you actually done? Because in the end, you're still competing against all the other startups that are raising money, right? And investors are looking at lots of different deals, and they're going to compare you along all these different things. They're going to say, well, how does this team compare to that team? And, you know, how exciting and how big of a business could this be? And one of the next things that they're going to ask is, like, what have you actually done? And particularly with tech startups and software companies in particular, the cost of doing it is dropping to zero. Like, it used to cost a lot of money to get started, and now really the only cost that is substantial are the people that you have to pay to go do it. And all the other costs have gone away. You don't have to buy software, you don't have to buy hardware, you don't have to pay for marketing. There's all these things that you can do at low or incrementally zero cost. And so one of the things that does, and it's a great thing, it democratizes entrepreneurship. It makes it so that anybody can start a business. But it means that it puts a higher threshold, a higher bar on you to show what you can get done, because anybody can go do this. So just having an idea, well, anybody can just have an idea. Like, well, show what you could do with that idea, how resourceful you could be. Yeah, it's going to take money to get it done, but what could you get done without money? That says a lot about you, and that's what a lot of investors are going to look at. Not every business can go launch, you know, without going and raising funding first, but a lot of businesses can, and usually more than what people think that they can. And so, what can you get done? Best traction is customers paying you money. Great, you know, like having lots of customers is great. If you have enough of those, you don't need investors. That's even better. But there's a whole spectrum of traction between customer having a contract and paying you money and having nothing, right? And so you have to, and part of that's salesmanship. That's also how you build that up and describe it. But how do you figure out, okay, well, I can't get them to sign up and to sign a big contract. Can I get them to sign up and just do it once? I can't get them to pay. Can I get them to use it for free? I can't get them to use it for free. Can I get them to commit that if I build it, they will use it for free? You know, I have done this many customer interviews, and here's all this information I have about what I've learned and what they've told me. There's all this other stuff you can get that would count as traction and would get you further with investors. Another thing is social proof from a key investor, and that is that a lot of investors are lazy and they follow other investors. The following the other investor thing is like, oh, well, if that person is investing, then I don't have to really think about it. I don't have to do my homework. I can just do it because they're doing it. And actually, a lot of investors work that way. And so getting that, there's certain investors who tend to be first movers. They tend to be people that are willing to make that decision on their own without having other people involved. And other investors know that, and they follow the lead of those people. And so knowing who are the really active investors, who are people that are willing to be kind of one of the first investors, and having that be someone that other people are going to recognize gives you that social proof. A lot of times that's why you might join an accelerator, right? Or be part of Capital Factory or Techstars or Y Combinator's, because that's part of your social proof that people say, oh, well, if they believe in you, if they're part of what you're doing, then I'm more willing to take another look at it. And then the last thing is a minimum viable product, and this is having an actual working, functioning product. A minimum viable product is often confused to mean a crappy product, and that is not what it means. It actually usually still needs to be an awesome product, because otherwise it's not going to teach you anything. It's not going to show that anybody wants it. It just means that you're building the minimum amount of stuff you need to build to be awesome, and to have people want to go use it and ideally be willing to pay for it. And you'll notice that I actually put that at the end separate from customer traction. because it's actually possible to have customer traction without having a minimum viable product, both in some of the ways that I described, by getting people to pay in advance, which if you're building something really valuable, they will do, or other things like that. But usually, again, if on the spectrum of all these things, if you have a super awesome team, then maybe the rest of this doesn't matter. If you're going after this really ambitious market and you've got other investors who believe in it, then maybe that doesn't matter. If you've got a really lot of traction, then you probably don't need a minimum viable product. But in general, you need all these things. And you're going to have something up and running and that you can show to people that says you've been able to, that the dogs will eat the dog food, that this thing is real and people will do it. And part of that's just because it's so easy to build startups compared to how it used to be. And part of it's because there's so much stuff out there that they're comparing me to other things, and lots of other people are going to have this. They're going to have something in market to go look at. So that's kind of a summary of those 5 things. I go into a little bit more detail in the blog post, so I encourage you to check that out as well. But when I wrote that at the end of last year in December, thinking about kind of where the market was at now and what we're seeing and what valuations are like and what kind of money people are trying to raise. And this is a question that I get asked a really lot by startups that I'm going and talking to, and that's was kind of my thesis for this year. And why $500,000? I want to mention that too. So I think $500,000 is kind of the magic number. It could be more than $500,000. Again, I put it as a range of $500,000 to $1.5 million, which tends to be a typical seed round. That's in Austin. That's enough money to get a year and a half worth of runway for most startups, for most small teams. And that's typically enough to go get to your next milestone. And I talk in the blog post about some of those milestones are typically that you're probably trying to get to tens of thousands of dollars a month in recurring revenue. And the one thing I will say is a very common practice, which honestly I did with my last startup, and if anybody's guilty of encouraging people to do this in the past, it was me, but I've changed my mind about it, is what they call a rolling close, where you get one investor to give you $25,000 and you close that and take it, and you get somebody else to give you $50,000 and you close that and take it, and you're basically doing that. Usually when you start doing that, it takes a long time, so you do that over 9 months or 12 months, and you're collecting investments a little bit by bit. The problem with that is you never know how much money you're going to actually have. You can optimistic, you have a number you're trying to hit, but that's just a random number you made up. But because you're not closing it all at once, you can actually know how much you're going to get. And each month, you're kind of living month to month. You're spending that money that you're getting as an investment, but you can't make big investments, and you can't make a key hire or do certain things because you don't really know how much money you're going to have. And you don't know if you're going to get another investment next month. So you have to be a lot more cautious. And when you get that big chunk of money all at once, which is traditionally the way it used to work more commonly when you're raising funding, then you can make plans. You can be like, okay, well, I've got this much money for the next year or this much amount of time, and here's what I'm going to do. And I can put together a budget, and I can actually make some investments. I can test some marketing things. I can make a key hire because I know what I can go do with it. So that's another thing I've been really encouraging people this year is to really focus on trying to gather your investors up into a close of at least $500,000. And while we've made a lot of investments this year, that's a requirement we've been putting on it, is saying, hey, we'll commit to giving you $100,000, $200,000, but we want you to round up the rest of it first so you get all that money at once. And so you're getting that with enough runway to really go work on it. Okay, how to meet investors. So a couple things about meeting investors. First of all, as I mentioned before, you have to think about the market you're in. And a really common question is going to be, should I bootstrap my business or raise venture capital? Or often, as these become a spectrum, when should I go raise venture capital? And I found this slide. I'm sorry you can't all see everyone on that side. We're working on the other projector. But I found this slide to be really helpful. And basically, what it says is there's 2 main vectors or 2 main things you want to consider when deciding if your business is appropriate for venture capital. The first one is how scalable is the business? This is the market size question I said before. Really, is it a big enough business to support venture capital? Because if it's not big enough, then they aren't going to invest in it. And your only option is to bootstrap it. And the other one is how much money does it take? Because if it takes a really lot of money, then you pretty much have to do venture capital because it takes a really lot of money. And if it doesn't, you might have some choices. And so the easy ones are, well, if it's a really big business, it can become very big, and it takes a lot of money. Then really you're in the upper right-hand corner. You have to get venture capital. That's the only way to do it. If it's can't be that big of a business, and it doesn't take much money, then you're in the bottom corner. You should bootstrap it because no VC is going to invest in it, and you can. It doesn't take that much money. If it's not very scalable and takes a lot of money, then it's just a bad business. That's the bottom right-hand corner. You just The slightly interesting part is the upper left-hand corner, which is what if it's a really scalable business and it doesn't take that much money, like a lot of software businesses, a lot of SaaS businesses. Then you want to look at how competitive is it, and how, if I start doing it, how hard is it for someone to compete with me? Because in those cases, typically, if it's very competitive and it's easy for people to compete, then having a lot of money lets you move faster and gain more market share and compete better against the other people. Whereas if once you start doing it, it's a niche market that other people wouldn't go after, or it's something where it's hard for people to compete with you because you get some immediate network effects, then you might not need to raise venture capital because you might be able to go a little bit slower. So this is just a helpful slide on how to think about it. I want to go through the different accelerators and investors in town. These lists are changing all the time. I said things are getting better and better. That's one of the great things about being in Austin. And so every time I make one of these slides, I give this presentation every month. I'm always adding something to it, removing something from it. You'll probably yell at something that I'm missing as I go through these. But here are the accelerators in town. And actually, I'm going to add one right now because I just remember there's another one called Manifest, which is a cybersecurity accelerator. And accelerators are going to typically be programs that include both mentorship and funding, and are really helping you, obviously accelerate your business, make you go faster to go grow it. Athena Health is really interesting because their program focuses specifically on startups that sell into doctors' offices and doctors, because they have a big network of doctors that are their customers. And so if they find something that they think is complementary, they can both invest in it and then help give you access to their distribution channel of all their doctors so they can get all their doctors to go use it. So I think that's a really great program. The Capital Factory program runs year-round. Our accelerator program is really about plugging you into all of the deal flow of opportunities coming through Austin and through your Capital Factory. So for us, that means helping you build your team, hire your first employees, meet your co-founders, get your first investors, get your first customers, all those key first things that happen. And we've got a whole team of people here designed to help you to do that. And this place with all this stuff happening on attracts all those opportunities, which we then are constantly handing out to all of the startups. Manifest is a fairly new program. They're focused on cybersecurity companies, so they have some great cybersecurity experts that are helping to run that. Techstars is part of a global program where the accelerator is running in many different cities, and they have one running here in Austin that runs once a year and focuses on tech startups. They don't just do companies from Austin. In fact, most of the companies are not from Austin, but every year there's at least one or two that are in there. And that's a traditional kind of 3-month boot camp style accelerator. Texas Venture Labs is a really interesting accelerator program. It's run out of the University of Texas. And what's interesting about that is when your company gets into Texas Venture Labs, what you get is a team of MBAs from the business school who then work on your company for a semester. And they're doing the work, and they're in the accelerator, but your company benefits from it. And then Unlimited USA is a program focused on social good companies. And so they help, they're selecting social good companies and helping them give them mentorship and acceleration and things like that too. Actually, I just remembered, there's another one called Tarmac, which is another social good program that is running this year at Galvanize. And it's also helping to find social entrepreneurship companies and help promote them. So then also there's the Central Texas Angel Network. If you're fundraising in town, you need to know about CTAN, as it's the short name for it is. CTAN is one of the largest and most active angel investor groups in the country. So they have over 100, I think closer to 200 angel investors in the group. And they have a pretty formalized process. They have teams that break out depending on whether you're B2B or B2C or different industries or things like that. And they have a regular cycle that happens on I think a bi-monthly basis where you can apply, get filtered through different levels of pitching to them, and ideally, if you make it, get down to be the last few companies that pitch all of the whole partnership. Good question?
Questions, but like, does that actually facilitate for here as well, or do you just simply have to go?
CTAN is its own organization. I'm a member of CTAN, and they're great partners of ours. They do a lot of their events and meetings here at Capital Factory, and they do them other places as well. So it is its own thing you go apply for, and that's just I think it's centraltexasangelnetwork.org. Maybe there's a shorter version, but I think that's the whole thing. But anyway, they are actually, like I said, one of the most active angel groups in the country. So they write a lot of checks. They invest in a lot of companies, and so it's a great resource that we have here. But most of the companies that I talk to, they want to get investors. They want to get venture capital companies to invest in them. And so these are the ones that are based here and primarily investing here. Like I said, it seems like there's always new ones to add. I probably should add John's group onto here as well, although I think he's focused all over the U.S., not just here on Austin. The Cavu is Clayton Christopher. He founded Sweet Leaf Tea and Deep Eddy Vodka, and so he really knows consumer packaged goods and things that require distribution. And so he's got a fund that's focused on investing in CPG companies and has been doing really, really well. Live Oak Venture Partners is one of the largest funds in town, and they do tech seed and Series A deals. There's a lot of VC firms that do seed and Series A tech deals. Silverton Partners is probably the most active and one that we've done the most deals with. And then Next Coast Ventures, Tom Ball, who used to be at Austin Ventures, is also doing those same kinds of deals. S3 Ventures has traditionally done, in the past, done more health tech, and they've now been doing more SaaS deals as well. They're probably one of the only ones in town that can write a larger check into like a Series B deal. And Craig Cummings is a fairly new fund with Moonshots Capital. They do all kinds of tech deals, but in particular they focus on military veteran-led companies. In a similar way, True Wealth Venture Partners with Sarah Brand and Carrie Rupp is focused on teams that have a female on the executive team and sell into the home market. So those are most of the most active firms in town. But like I said, one of the great things right now is that I feel like I know probably 5 other people raising funds right now, and there's new ones coming on all the time. A couple other quick notes, and then we're going to jump into Q&A. I'm just going to talk to these briefly because we started a little bit late, but these are all things we could talk more about in the Q&A if you want. As far as how you structure your investment, there's basically 3 options for what your documents look like, and there's basically a convertible note. It's called a SAFE, which is just a newer, more updated version of what a convertible note was being used for, and then a price round or an equity round. And 95% of the companies that we talk to do a convertible note. And they do that because it's easy and it's fast and it's cheap, and in some ways it defers them having to make some decisions or deal with some other things that you would have to do if you did a price round. A big part of making fundraising easy is making it easy for the investors. There's lots of places you want to be creative with your business. You want to be creative in your product, in your marketing, and how you hire people. You don't want to be creative in your fundraising. You want your fundraising to be totally boring and look just like every other fundraising. Because not being boring is confusing and takes work and makes it hard for the investors to invest because they have to go figure out that thing you're doing. Whereas if it looks just like everything else, then they don't think about that part. They just move on to the creative parts of your business, like your team and what you're building and how you're marketing it and all the other stuff. And so the convertible note is like the simplest, easiest thing that you can get a standard convertible note off the net that everybody's seen, has the same terms everybody's used to, and they're just going to look at it and not question it. And there's really like 3 blanks to fill in for like how much money are they giving you, what's the cap or effectively the valuation on the note, and maybe like the interest rate or some things like that. But it's really simple, and that's the biggest reason that people do it. If you're going to do a price round, then even with the convertible note, you're going to agree on a price effectively. And anytime you're doing that, you really want to try to do that with an experienced investor who's going to be able to get the right price, because you can really kind of screw up your company by picking the wrong price to start, and that can be if the price is too low or if it's too high. But the note is a little bit safer way of dealing with that. And then the price round is a full regular investment, which means somebody's buying shares of ownership in your company, which takes just a lot more documents and documentation. Your company has to be a little more formalized and further along, and it's going to cost more from a legal perspective and things like that. There are benefits, pros and cons either way. We can kind of talk about that a little bit more if you want to. As far as what valuation you get, what's the value of your company when you get the investment, which really directly relates to like what percentage of the company are you giving up. The valuation is going to range a little bit, but typically if you're on that list of those things I talked about and you're not a serial entrepreneur who's gone and done this before, and you don't have a ton of traction beyond that kind of initial getting things going, then you're worth about $3 million. And it's a fairly arbitrary number, but that's the market. That's kind of like where you get started. Because typically, if you're raising $500,000 and you were worth less than $3 million, then the whole thing breaks. You give up too much of the company to begin with, and you wouldn't be able to go raise more money. So that's like the least it can work. Sometimes it's $2 million, maybe, but usually that's where it's around, and that's somewhat arbitrary. If you have other factors like a really strong team or traction or other things, those are going to raise your valuation up. It might go to 4 or to 5. If you have, $50,000 a month in revenue, then you're probably going to be more like 5 or 6 or around there. And if you have a serial entrepreneur on the team who's done this before, then that'll often double the valuation. You might be starting at 6 or 8 or something like that, just because more other investors are going to feel more competitive. They're going to feel like they want to get in on the deal. And then on time, I already talked to the roll and close concept a little bit, but I would just say that it always takes a lot longer than you think it's going to. Most people I meet show up and they're like, yeah, I'm raising funding and I have 60 days worth of runway left. And like it takes 6 to 9 months to raise funding from when you're like really starting. Occasionally things happen faster and magic happens, but like usually it takes a long time and it takes a lot of meeting people and working on it and iterating on things. So just you have to have runway to go into fundraising. You have to be able to operate for a period of time without money to make that happen. I think one of the last things I'll leave you with is, from an investment perspective, certainly how one way I think about it, and a lot of investors I know, this is a quote from Mark Sister, who's a really well-known investor from Los Angeles. Upfront Ventures is the name of his firm. But he wrote this back in 2010. It was a blog post where he said, I invest in lines, not dots. And what he means by that is when you meet somebody at a point in time, you've got a dot. You know where they are. You know what they're doing. You know who, kind of them now. But you don't really see a trajectory. And when you meet somebody over a period of time, then you can draw a line. Because I saw them here, and then 2 months later they were here, and then they were here, and then they were here, and now I have some idea where they're going. And I want to see where you're really investing in is where they're going, not where they are. And so when you think about, that's also why it takes time. Because typically when you have to meet investors multiple times. They're going to want to meet you, and they're going to talk to you again a few weeks later. Like, see, what have you done? What kind of progress have you made? Right? If it all sounds the same, then that's not going to be very impressive. And so to think about how are you going to even play that out? Are you going to set that story so that you can tell a good story to the investors and they can see you making progress and learning and growing? All right, and one great resource, if you're interested in this kind of thing, there's kind of the Bible for this type of this whole topic. It's called Venture Deals. They just released a new edition. It was written by Brad Feld and Jason Mendelson from Foundry Group. Brad's one of the founders of Techstars and really great entrepreneur and investor. And so great resource just to go learn more about it as well. And I think we're doing pretty good on time. I'm going to invite John Bassett up here now. He is, I first met him when he was over at Silverton Partners. And we were working on a bunch of deals through that then. And he's got a new venture firm, which I think I'm going to let him tell you a little bit about. That's a microphone you can put on. You have to flip the switch and then throw that over here. And I'll let you tell them a little bit about your new fund, and then we'll open it up for Q&A. So, you guys hear me? Is that working? Yeah, good. I don't do this for a living like Josh. I'm not used to wiring these things up, wiring myself up. All right. So, John, tell us a little bit about your firm and tell me if I should put it on our slide for Austin firms.
You should. So our firm's Next Gen Venture Partners. We have a $22 million fund focused on seed stage venture deals around the country. I think that the real aim here was to be different from a lot of venture funds, and having worked for Silverton Partners, great firm here in town, having worked for DFJ, great firm in California, most funds will tell you how much value they will add beyond the check they write. It's almost like a marketing line. And it's not for lack of effort, it's just a time management thing. Most firms are a couple of partners and they only have so much bandwidth. In between board meetings and chasing new deals and travel, it's hard to spend a lot of dedicated time with any one company. So at NextGen, we took this concept of a venture partner, which is someone who helps a venture fund, and we're on our way to building 1,000 venture partner venture firm. We have 750 people in our network. That includes the head of special projects at SpaceX, the chief strategy officer at SAP, the CEO of Blackboard Learning System, the VP of engineering at Box, the VP of engineering at Twitter. And all these people are friends of NextGen. They refer us deals. They help us diligence investment opportunities. But most importantly, they're there to help you with BD introductions, customer introductions, sales efforts, hiring needs. And we facilitate a lot of that stuff on our platform. So the goal is really to come with a different model, to add more value beyond the check we write, and then to have our eyes and ears on deals nationwide through this network of people who are placed in the right places to see this stuff early. So, that's what we're up to. We've done 12 or 13 deals to date out of the fund. They're almost evenly a third California, a third Texas, a third East Coast. We're open to deals in the Midwest and, Dallas, Houston, Austin, pretty much anywhere, but they've got to get validation through one of our venture partners and kind of pass the diligence test there. So I'll leave you there.
Awesome.
Yeah.
Great. Well, thanks for joining us. Like I said, now we've got a little more than a half an hour left for the Ask Me Anything session. So we're happy to talk about anything that you guys want, about anything that we covered in the slides today, about fundraising for your startup or anything else like that. Start in front.
So, obviously people want money, but what would you consider to be conditions that you should never accept money under? I mean, obviously there's going to be a set of things that are okay, this is kosher, this is good, this is what everyone would do and consider acceptable. What are things that you would say are things that you should never be okay, yeah, I'll sign this?
Wow, there's lots of things you should never do. The first thing I would say is just along those lines of, I guess, how do you vet your investors and the deal that you're getting? Is one, you just, there is a market, and so you want to be able to talk to people that have seen lots of things. So if you're talking to an investor, first of all, you want to know, how many other investments have you made before? Is this something you do all the time? And has it been in companies like mine? And if not, then that just means you probably want to run it by other people too that have. One of the great things about being here at Capital Factory is we have a big network, so we see lots of deals. And so when somebody brings us a funny deal, we can look at it and be like, well, that's weird. We see lots of deals. That's not usually in there. Or, oh, no, that's there all the time. That's supposed to be there. And I think the value of John's network, like he was describing, is similar. But then the biggest thing I would do is just you want to due diligence your investors the same way that they're due diligence in you. And so usually you don't even need to ask their help. You can go figure out who else they've invested in, and then go email their CEOs and be like, hey, would you talk to me? I'm thinking about taking investment from this firm. I want to know what it's like. And I find CEOs are pretty candid, and they'll tell you. You can say how have they helped? How have they been value added? What have they done for you? See if they can give you really good examples, right? Or how how things not gone well. If you're going to ask for a reference from them, ask them to introduce you to one of the companies that didn't work out. Everybody's nice when everything's working really well. It's how do they behave when things don't go well? And that's, I think, that's one of the things I'd ask about.
For reference, I would say no response or a neutral response is a bad thing, because I hope our CEOs are chomping at the bit to give us praise. You can find out by emailing them. The other way I'd answer it is I think entrepreneurs, and again, I'm on the other side of the table, so take this with a grain of salt. I think entrepreneurs tend to spend too much time on valuation and not enough time on other key terms in the documents. And I can give you whatever valuation you want. If I'm a conniving investor, I can put in a liquidation preference or board approval for expenses or millions of things that will make your life hell, and we don't do that. But don't spend so much time worrying about valuation and net ownership. Spend more time worrying about kind of the complete set of terms.
Yeah, so if you need to go about getting a license for a particular technology, either from a university or a company, how would you go about preparing for making that first contact with them and asking if they'd be willing to license their technology to you?
So every university I know of has a tech transfer program specifically set up to take university technology out or work with groups that want to license it. I'd start there.
Right. No, I could just be some Joe Schmo off the street. Why would the university license their technology out to just some guy off the street, right? Maybe because they're having to pay they have to pay for that patent, and they have to pay annual dues on that, and so they don't. So if I were the university, I wouldn't necessarily want to license it out to somebody who isn't going to be making me licensing fees.
Yeah, I think to Josh's earlier point, I think you mentioned building a strong team is one of the best things you can do. I'm not sure university will just lend out technology to the first person that shows up, but there's things you can do to stack the cards in your favor, right? Build out a team, add value and create something first before going to them and sort of asking for that technology. Potentially raising money from value-add investors to show that you're a going concern and have money in the bank and can pay your bills for a set period of time. So, stack the cards in your favor to make yourself look more viable. I don't know if you want to add to that.
Yeah, no, I think that those are great suggestions. In the end, look, in general, I think it's very low risk for them. So they're gonna, and I think university tech transfer is usually eagerly looking for people to go take their stuff and go with it. So I think it's just the same kind of salesmanship you need to do to sell to anybody else. You're gonna have to show them that you're credible and you're serious, and that's by having expertise and what are the things you can do without them. How far can you go without having that to show them that you're really serious and you thought about it?
I guess my question is convertible notes. So we're in the middle of raising around right now. Got about 200 or 750 that was, but our question is, I know you said don't be creative with how you raise. Is there any hesitation? So I guess what we're considering doing is building some of our partners' hours against the convertible note. Is that something you've seen before? If so, are there specific terms that you'd be weary of?
So is your partners, are these like contractors and people that?
Yes, some key partners who would be developing parts of like the overall technology.
Right. So just in case, can everybody hear him on that side? So you said we have raised about 250,000 out of target about 750, and they're working on that on a convertible note. But then they've apparently got some vendors or contractors they're working with who are willing to, instead of getting paid, if I understood you correctly, which is the way I've done this in the past, would say they were going to bill me $50,000. They'd say, okay, great, I'm not going to pay you the $50,000. I'm going to pretend like I paid you and you paid me the money right back and invested it in the company. And now you have $50,000 on a convertible note. And personally, I really like that approach. Like, I think if they'll agree to do that, that's great. Or sometimes they'll agree to do it for like half of the money, or something like that. And now they're basically just investing in your company. So that's great, and they should, that's a pretty good option for me.
Yeah, I just make sure that you're taking in enough cash to get to whatever milestones you need to get to. If you need to raise the cap on the note to account for that additional sweat equity or sweat debt, just make sure you raise enough money to get to the next kind of key milestone. Yeah.
Good questions?
A couple questions. The first one would be, seeing as the bar is so high for first-time founders, what is it that an investor would look for at first-time founders to sort of really be like, yes, I want to invest in this person? And then secondly, just getting to know the Austin tech scene, the investment scene. If a company was to have a lot of traction as far as growth, rather than paying customers, but more like we've got customers who are kind of attracted to paying customers. Would an investor want to invest in that type of thing, or would they want to invest in when it has traction as far as money?
I'll take the first part. I may have to have you repeat the second part. But something we talk a lot about internally is I sort of train our deal team is there's sort of 3 pillars that are going to get you initially excited. Or when we review like 3,000 deals a year, so you have to be pretty ruthless in terms of like what passes the bar and what doesn't. And so the 3 areas we tend to focus on at the seed stage are team, traction, and co-investors. And so as far as first-time founders concerned, we look a lot about who else is around the table, who's involved as advisors, and are they really involved, or are they just kind of advisors in name only? What have you done in a prior life? The thing I love to look for is like every experience you've had has led you to this moment, whether it's just epiphany or like, you can tell a story of I was doing this thing and saw that it was broken, so I went and got experience here and saw that they didn't have a better solution, and so I decided to start my own and crafting that narrative. Traction comes in a lot of ways, and so we'll overlook first-time founders. Happy to work with a first-time founder, but if traction's there, that speaks volumes way more than even sometimes the team involved, right? And then I think co-investor is a sort of poor man's way of assessing quality, right? If Sequoia's in your seed round, I don't have to do a lot of homework, right? They're the preeminent venture fund, presumably they've done the homework, and so I'll come along for the ride. So, I think on the team piece, experience, other people around you, advisors and their involvement, a vote of confidence from other people that the investors look to as sort of legitimate representatives, things like that.
Yeah, I think those are great answers, and I think very in line with what it takes to raise 500K kind of thing. For me, the main thing I'm looking for with a first-time founder, I'd say two things. One is and this is a very subjective kind of thing, but like I need to believe in you. You need to be unstoppable. I need to look at you and be like, that person is gonna succeed no matter what. Like whatever gets in their way, they're gonna overcome it, and they're gonna figure it out. And that's someone that's tenacious and resourceful and passionate. They have to really care about what they're gonna go do, because it's really hard. People who don't really care they're not gonna make it to the end, things like that, and they're not gonna persevere. So that's the first thing, is I just really have to believe in you. And I teach a class at UT for student entrepreneurs, and I've invested in quite a few students coming out of my class at UT. And again, it's usually pretty obvious. I'm just very often they may not be as far along, they might not have as much traction. But I look at this person and I'm like, this person is gonna be super fucking successful. Like that person is gonna go really, really far. And then you're still buying a little bit of a lottery ticket. You don't know. I don't know if it's going to be this company or the next one, but I'm going to bet on that person. And then you know what? I'm also even buying a ticket for the next round. Maybe this one won't work out, but I'm going to bet on this time so that they let me in the next one, because I'm sticking with this person. And then the second thing would kind of be maybe he talked about co-investors, and at Capital Factory we invest in people we know. What our advantage is we have ways to get to know people better than most other people. And so we do that because we live with them, or we have so many people in our network to make them interact with, and so they come and interact with each other. And I hear what all the other startups are saying about them, and they interact with the mentors, and we see what the mentors think about them, and they're interacting with visitors from out of town, and we see what those investors think about them, and then we have big companies here, and they're interacting, and we see which ones the big companies like. So we're looking at all this kind of these data points all around it, and you're gonna have to build up some of those data points.
And as far as attraction is concerned, with investors started looking for traction in the form of how much money you've made from customers, or what if you were looking at all the way to get certain people on it to attract those customers who had a lot of traction?
Yeah, it's tough to assess traction in a vacuum. I think it can be revenue, it can be a letter of intent, it can be daily active users, monthly active users. There's different ratios we look for in this world. So there's a bunch of different metrics. I think the important thing is to let your investors know what metrics you track, what are your key performance indicators, how you're tracking against those. Ideally, don't under promise and over deliver to the point about dots and lines. Like every interaction, I should see your KPIs improving, trending towards a goal. So I don't want to throw out hard numbers, but I think let people know what metrics you're tracking. There's a few that everyone sort of looks to depending on what type of business you have, and make sure your metrics aren't weird and different. Right? Make sure they look like other companies like yours metrics, so we can compare apples to apples.
Yeah, I think this is a very classic Austin question. Is people would say, can I do a B2C startup, which would be typically one that would be focused more on user activity and then revenue early on. And again, I would come back to, it's actually a question of everywhere that's not Silicon Valley, because that's really the only place if it's ever easy, it's easy to do that there are lots of investors who understand it and made money on it. And so everywhere else, the bar is going to be higher if it's not revenue traction, if it's user traction, which means you're going to have to show faster growth. And part of the faster growth is, if you're going to do a business like that, you have to be able to effectively acquire users for free or very, very cheap. So you have to be growing and not paying for them. So usually that means you're viral, that something about using the product gets more people to sign up. And so if you have a business that's growing quickly and doesn't cost a lot can do that efficiently, then that's going to start to look interesting and attractive. If it's this is growing really fast, but we spend a lot of money to make it grow really fast, that's not very sustainable for a business that doesn't make money.
And don't view fundraising as a one-time thing. You're going to need more money,
right?
So it's about building relationships. And I may say no today, it doesn't mean we're a no 6 months from now, right? And I think there's things you can do to stack the cards in your favor if you're a first-time entrepreneur. Weekly or monthly updates that you include investors on. Potential investors. I get emails all the time from people in my network who might know you, and if they vouch for you, it increases the likelihood of me wanting to invest in you. Be forthcoming with information. Be timely to respond. I mean, these things seem obvious, but you'd be surprised how many times, you know, I'll respond in 5 minutes and it'll take an entrepreneur 5 days to get me the like information I asked for, right? And so it's just not a positive, like not a vote of confidence, right? Like they're going to be able to execute quickly.
When you respond quickly, it makes it look like you have your shit together, right? As opposed to like you take a long time. It's like, well, like if you do it fast, like well they had all that organized, they could do that, and you know, do that
And
well.
if you think updating, like weekly or monthly updates are hard, I would argue you are a bad CEO. Like all your reports should be doing that. If you're a one-person company, I might give you a little bit of credit, but if you have someone running sales, they should be able to pull the sales numbers. Someone who does finance should get you the financials, right? Like, well, your only job is aggregating that stuff and sending it out, right? You shouldn't be having to look around. I should be able to ask you what's your customer acquisition cost, what's your lifetime value, how many customers do you have? And it infuriates me when people say, well, we have about 17, and our churn, you know, I don't know, we're not really sure how to calculate churn or.
Right. But you
it's
gotta
like,
know it.
Okay, there's next taxi, right? There's 3,000 of these things I'm gonna look at, like, you gotta have it together, so.
Yeah, and I want to add one more thing too. You know, you talked about coming back as an investor. I may not invest now, but I might invest 6 months later. I would say it's totally true across the board. It's even more true with angel investors. And so many entrepreneurs will come through Capital Factory, and they'll go through office hours, and they'll be like, I met with all the investors. And I'll be like, okay, well, when did you start? That was like 6 months ago they started that process. And I'm like, okay, well, you met with everybody once. Like, have you gone back and met with them again? And they're like, well, no. I'm like, well, this person said no. They said they're not interested in this at all. I'm like, go meet with them again. Because it's 6 months later. You've made so much progress in that time. Your business has changed. Your story has changed. And their life has changed. Especially with angel investors. The angel investors are very fickle. The reason they invest, like, if last month they got a big check, suddenly they might feel totally different because now they got a bunch of money in the bank. Or, you know, and people just change their minds. Like, people will look at stuff and they will say, I'm never going to invest in that. And they will totally still invest in it, like 6 months later. And they'll say, well, things were different. Your business changed. Something else changed. And so I just really encourage you to not take any no's as like a final no, and realize that, again, it takes multiple interactions. And, you know, a lot of people have won me over time, and I've seen them win lots of other people over by coming, you know, okay, that person said no, and they just pretend like they didn't say no. Like they said come back later. And they just like keep sending updates and keep coming back. And then after getting updates from somebody for 6 months that you kind of were ignoring, and maybe you didn't even read half the updates because like they came in, but you know you got them. And you're like, that person, they're on it. They're like on their ticker. And then you go back and you read the last 2 or 3 updates because they're sitting in your inbox because they've been sending them to you. And then you start to feel differently about them. And so I just would really encourage you to not take no for an answer as that initial one. I've been watching a bunch of hands going up, so I'm going to work my way back over to all of you guys. We still got a good amount of time.
What do you think about friends level with Bassett? So if you have friends who have more or less unlimited resources and investment versus finding venture capitalists. So for example, if you have friends who have investment but also have expertise that would be useful to you, but they need some expertise.
So you're friends with unlimited amounts of money, is that what you said? I'm talking to
What are their names?
So his question was, if you have friends, should you take money from friends who may not have any expertise, but may have some, but have money to invest, or should you avoid that? And I think that's a really tough question. It kind of depends how much you like your friends, how much you want to keep them. No, I mean, it's kind of the same thing would apply to family. I mean, honestly, I would say generally I would avoid it if you can. Lots of people don't have choices. We can talk about all kinds of things you should do. Most people don't have any choices. They have to do like the only option. They have one option. I'm not saying like obviously that you don't want to be in that situation, but I will tell you a lot of people I see, they end up having one choice. And so if your choice is like the only place I got to raise money from is my friend, then you should, and they want to do it, then you should make sure they know what they're getting into. And there's a bunch of things you could do to like be really clear about that up front and other things, but take it. But in general, no, I wouldn't want to be taking money from friends and family and other people because they're not professional investors. They don't really know what they're getting into. It's likely, and because these things they're likely to not work. So then you're likely to lose your friend's money. And that's,
these people actually, they are professional investors. They've invested in multiple companies.
yeah.
But they're friends.
You got to kind of decide that for yourself. Like my friends are all investors. Like that's the crowd I hang out with, and that's what we do. So like I wouldn't think twice about asking them. But we're doing that all the time with lots of stuff. So I think you got to really think about how to affect your friendship.
The relationship will change.
White shirt back.
It's a related question. Where have the that stage where it's friends, families, and fools put in money. Is there a way to structure that so that it does help the narrative and does keep it clean going forward towards getting next step?
And just one, use standard docs, like use a standard convertible note, and like keep that all really clean and simple, so there's nothing weird or funny in it. I mean, it's good that your friends and family believe in you. That's not a bad sign. That's like a good sign. The investors just don't want them to be a pain in the ass. You know, like, so it's just.
So I think some tactical things. Use standard docs. I think Cooley has a set of standard term sheet docs. Cooley, they're a big law firm, Cooley. They're free docs you can download. If you have too many people, the cap table, which spells out the ownership structure, gets really messy, and future investors don't like that. So if there's a way to bring people in one structure, like a special purpose vehicle or an LLC, that will keep the cap table cleaner. Keep the valuation fair. Don't make it a bargain. If you give away too much of the company, future investors are going to have you renegotiate that. If the valuation's too high, there's going to be a cram down and people are going to be unhappy. So I think, keep the cap table clean, keep the terms simple, make sure friends, family, and fools know what they're getting into, but those sorts of things. Yep.
What does the investor think, the investment company that is against the trend? For example, 2010, bottle and drives through all the empty office parks, and then WeWork coming and disrupting that industry. So what we try to do is, those companies want to go online, the retail, they're, leaving. So we want to help product company, innovative product company, to solve the discovery, and then before they can again go into the big box store. So we want to set up showroom and brick mortar retail stores, use showroom model versus wholesale retail. Like absolutely product companies. So
Yeah, so I think it's a great question. I think you're going to find there's probably two kinds of investors from a broad perspective from that. And there's investors who are very much following what's hot, and there's investors who are maybe looking for the hidden gems or looking for that thing nobody else sees. There's much more that are just looking for what's hot. Right now it's VR and AI and machine learning and computer vision and Internet of Things, right? And if you're in those things, then it's going to be easy to get funded, and lots of people are interested in it. But probably, I would argue, probably a lot of the smartest investors are actually the ones that are contrarian, that are looking for things that everyone else doesn't see. Peter Thiel has a way of saying this. He says, what do you think is true that nobody else thinks is true? That's your secret for your startup. I think Mike Maples from Floodgate says what you have to be non-consensus and right, or non-consensus and correct. That's kind of what you're saying. Not what everybody else thinks, but you're actually right. But that's what you have to, explain to them. And so when I'm pitching a business like that, usually the way I tell that story is I'm saying like, well, everybody thinks this, but actually it's really like this. This is what they don't realize. And you're gonna have to be able to tell that in a compelling way, to make people understand that. Sometimes it might be, a unique way into it. We have a company that we've invested in that was here for a long time called Own Local. And they sell the newspapers. Newspapers, not such a great place to be selling to these days. Like real newspapers, right? But they've got a really interesting twist on it. Newspapers have big sales forces, and they have big local sales teams, and that are well established. They have the client relationships. They know how to sell into small businesses. And so what they basically give these newspapers is a way to help them make more money with a digital product they can go put into these sales forces teams to sell to all these small businesses. And they've got a really great business. But they have to be able to really well articulate that and get over the bunch of people that are going to be like, what, you're in newspapers? I don't want to be in that business.
Yeah, so along the brick and mortar line, so what do you see firms are looking at real estate deals?
Excuse me?
What about real estate deals for real estate?
You generally wouldn't call it VC. So venture capital, just that structure and that asset class is not doing real estate. Typically that would be like, for large buildings, we would call it private equity or, kind of like a different asset class of investors. It's much less risky actually, usually like much more very standardized. So it's just generally you're going to be talking to a different group of people.
So if it's real estate technology, there's at least 3 funds I can share by name. Fifth Wall just raised a big fund. They were the ones who bought up all the houses for Blackstone after the financial collapse. They just raised a $250 million fund called Fifth Wall. Camber Creek in DC the LaFrac family office in New York. I mean, there's people out there looking for real estate tech.
Yeah, we have a lot of real estate tech companies here that are building
Yeah.
software for real estate
Right.
agents or a database of all the commercial real estate. But if you're talking like actually physically buying property, then that's a totally different group.
I think the moral of the story is know your investor, right? Founders Fund wants non-consensus crazy moonshots, right? Mike Maples has his little quadrant. But by and large, most investors are going to want like middle of the fairway enterprise software or trendy things. And to your earlier question, we just looked at and passed on a deal in New York that is taking retail space, carving it up into 8 by 8 foot sections, and then being a showroom for product. They raise money from some good funds, so it's a good idea. I'd be happy to share it. I can look through my email and find the name of it, but I think you're on to something interesting.
Who hasn't asked a question yet? In the yellow shirt in the back.
Is there anybody in town that sort of specializes in fintech or finance sort of stuff?
Startups or investors or what?
Investors.
I wouldn't say anything that specializes. I don't think anybody would be afraid of it. Soberton's in the Zebra, which is an insurance company that I kind of throw in the fintech space. There's lots of big fintech companies in town and big companies sort of like circling around startups here. BBVA has done a bunch of events here and things like that. Chase does stuff, SVB, others, but nobody that specializes.
No, again, I think a bit know your investors. Like New York tends to be hot on fintech. LA loves media tech. DC loves regulatory tech, and ed tech. So I could name 10 firms that do fintech, but they're mostly DC and New York.
Pusher?
Yeah, I'm gonna this investor thing. Probably saw this chart back before. So right now, I'm just kind of doing all of my savings and all that, my company. But these investors, are they just here's the money you work, or they help you out with their contacts, or for example, Shark Tank, like they say yes, I want to invest in you, and I have a lot of contacts.
Well, they all say they're going to help. What do you mean?
And I don't know, or they just get like monthly or weekly applicants, so that's it, or I don't know.
I think investors can be most helpful in raising your next round of investment. We regularly talk to all the investors that you would want to take money from, and we're going to be your biggest inside baseball advocate to them. I think they can help with hiring. I view a CEO's job as two things: hire great people and not run out of money. And I think we can help with those things. I think beyond I think we're well equipped to help with portfolio support. Again, I'm biased, but I think we have a better model. But I think by and large, it comes down to hours in the day and how are we going to move the needle, right? And introducing you to the 452nd customer is not going to move the needle a lot for the business. Helping you get financing so you don't go out of business will. Helping you hire your COO will, right? So we tend to focus on things that are going to move the needle a lot in your business, and some are more helpful than others. You'll find that out through talking to CEOs that have taken money and haven't worked out. But it's going to vary a lot by investor.
Yeah, it's going to be all over the place, and you can ask the investor that. What kind of investor are you? Are you a passive investor? Do you want to just write the check and not talk to me and forget about it? Or do you want to talk to me every week and see what's going on? And you want to know that because you want to know what kind of investor you're getting, right? Most investors are going to say they want to be involved, they want to be helpful, they're going to make introductions, they're going to introduce you to investors, to customers, to people you might hire. The most helpful VCs that I see generally are helpful with recruiting and the next round of investors. Those are the two big things. And so typically they'll have talent networks. It's often people that were kicking butt at the previous company they invested in. And now they sold that company, and then they just go pluck out all the great people out of it and put them at other companies they have, which is a really great resource for you. It's really good. And then the other thing, like John said, is introductions to other investors. They're networking to help you raise that next round of funding. One of the ways that Capital Factory tries to really differentiate ourselves, and of course, like I said, every investor is going to say that they do these kinds of things. What I think really sets us apart is I think we have developed these unique assets that allow us to add a lot of other value. So we can really help with recruiting and hiring because we have 100,000 programmers come through here every year that we can get people in front of, because we host events to meet all the people that are new to town and help plug them into stuff. We do a bunch of introductions to big companies because we have all these big companies that we work with that are here because they want to meet startups and go do business with them. It's Walmart and Mercedes and Merck and the Department of Defense and Booz Allen and all these big companies, and we're doing that, doing those things for them here. and then, introductions, investors, other things like that. But that's what they're all going to say they're going to do, and then it's really just a matter of how much they can actually deliver on it. And that's where I go interview other people that they've invested in and ask them, like, well, what's the most helpful thing they've done for you? Give me some, and then ask for examples, like, oh, they helped me with hiring. Well, like, who did they help you hire? How did they help you? What did they do? And you'll get kind of a sense for it.
What about if you're, I understand the capital, the venture capitals, but what if you're looking for advice from somebody? Not necessarily an investment, but you might be able to give them a portion of the company for their advice. You're not a tech person.
Yeah.
You have something, you're already funded, you already have, I don't even know all the words, product.
Yeah.
You have
There's lots, we call that mentoring or advising. There's lots of ways to get at that and do that. Part of being here at Capital Factory is there's a network of about over 150 other experienced entrepreneurs who like to talk to other entrepreneurs about what they're doing and try to help them, and they have expertise in a lot of different things. Part of the value of the Next Gen network that we're just hearing about is having that similar kind of network to tap into. The first thing I would suggest is just get as much free advice as you can first, because you can probably get a lot of really good free advice, and the free advice will often be better than the advice you pay for. So I would try to go get that first, and then once that'd be paid advice. I mean, if you have legal questions, I would talk to a lawyer. But I wouldn't talk to a lawyer about being your advisor as an entrepreneur, because lawyers are, by definition, being a lawyer is very not entrepreneurial, as much as they will try to tell you otherwise sometimes. So they're very risk averse, and you need to take very calculated risks. So most lawyers, I would not be my first place. But no, I want to talk to another entrepreneur. I want to talk to someone who's been through something like what I've done, who's built a business like the one I built, who's kind of been through that kind of thing, and is going to have really relevant experience for that, right?
I will say some of the best fundraising pitches start with, I'm not looking for money, I want some advice.
Yes.
I'm far more likely to give time to somebody who's a college student who needs advice than someone who says, I want money, and I'm going to say your business isn't a fit. So I'm not, don't do it in like a sort of conniving manner, but very, very common version of that saying is when you want advice, ask for money. When you want money, ask for advice.
And I understand you had your block up there where you had the venture capitalists eventually going to come in if your product is big enough, correct? No matter what, you would eventually get to that point. But I'm just curious. I just basically say that I have taken over business. I'm in the oil and gas industry, but now I have a tech business.
Yeah.
Okay, and it's already established and all that.
So you're in the right place. You want to be hanging out places like this and meeting the kind of people here that are going to be able to tap into that. But this is the right place to meet those kinds of people. Couple more.
I do have a question before my question. I would like to say I'm a business development attorney, and I work with entrepreneurs and startup companies. I would be more than happy to advise you on what you have. I completely understand where you come from. That is the general perspective of lawyers and attorneys that are in that world. Some of them can be risk averse, and that might be the stereotype, I guess you could say. But times are changing, as we can see here in Austin, across the United States, in the entrepreneurial world, and so things are changing also in the legal sphere. Again, I would be more than happy to meet with anyone of you and offer advice as it pertains to your business. And my question is, although you might be a little biased, what is your take on going the VC route versus going the SBA loan route with the Small Business Administration? Again, you might be a bit biased, but have you seen that work for anybody? Have you seen
Never.
any
Do you know anybody that's worked for? You got an SBA? I got an SBA loan for my first business that I bootstrapped and didn't raise money for.
So how did that go?
Slow.
Yeah, I mean, non-dilutive financing over dilutive financing is generally better for you. The caveat is it's often a lot of paperwork, it's really long sales cycles, and speed is often your only weapon in startup land. There's very few barriers to entry anymore. And waiting for approval, waiting for the 6-month cycle to open for the next class of SBA loans, waiting, you're going to wither on the vine in many cases. I think the question is non-dilutive versus dilutive. Like non-dilutive is a great alternative. Incubator, which is a division of the federal government, finds you groups inside the government that will pledge revenue, front money to you as revenue for non-recurring engineering expenses. DIUX, Defense Innovation Unit Experimental, will give you money free if it solves a problem that they're trying to solve internally. So there's sources of non-dilutive capital that I think are great. Generally, if it's going to be an application process or grant writing, or I think you're going to die on the vine. But I think non-dilutive financing is always a good option if it's quick.
Yeah, it's just usually slow and hard to get, and then you don't get a lot of money, and then and so I just don't see people doing it. Like the SBA's around here a bunch, and they come and they do workshops and they talk about the SBA loans. Nobody gets any SBA loans.
So that actually goes perfectly, because I was going to say between venture capital and angels, I mean, like, can you give like maybe just like the first two like advantages, disadvantages to each? I mean, because it seems like what you're doing sounds great for the venture capital, but that's not what most venture capitalists really do. Whereas like an angel, I feel like if anyone's willing to put that much skin into the game of their own money, they would want to be involved, and they probably have like real knowledge of whatever it is you're doing.
That's not necessarily a safe assumption. There are lots of people with too much money who will do irresponsible things with it. Yeah, I mean, the question was angels versus VC, and I think my general thing is, look, in general, you want to go as far up the stack as fast as you can. If you can get a VC to write you a $5 million check and you skip all the other stuff, like, you should go do that. Most people can't do that. Like, if you can do that, that's going to be way easier. You're going to skip all the time you spent pitching all those other people and all this other stuff, and you've got enough money to go and deep enough pockets to take you as far as you need to go. That's great. Just most people can't do it. For one more question, we'll do the back, and then I'll hang around after too.
My question is more from a personal investment that you made, like a company called Equidate, right? Like, I know a while ago, right? Like, there were no specific regulation that would control it. Like,
which company did I invest in?
Yeah.
Which one?
Equidate.
Equidate. I don't know that company.
Or Equity, it's a competitor to Equity Zen, I think.
Keep asking the question, but I'm not sure which one.
So it's basically a company. What it does is it basically takes stocks from companies that have not gone into an IPO and sells it to other investors. So that company did not have any, like, a while ago, about 2 years ago when it was founded, there were no regulations for it, but people did invest in it. And like, what would convince an investor to do something like that?
To invest in a business pre-regulation?
Yes, like if it could be something which is like maybe illegal. Like, I mean, there's no.
We got plenty of investors investing in illegal stuff right now. We have drones
not
and cannabis and all kinds of stuff.
Not like criminally illegal, but there's no regulation controlling it.
Yeah,
I think about it as like a risk-reward continuum, right? And if the reward is huge and the risk is minimal, I will take that bet. If the risk is high and the reward is not that big, I'm not willing to do it, right? We can back channel, new administrations. Like, you never know how things are going to pan out. But we've invested in a pharmacy benefits management company, a payday lending company. All these companies are trying to do it better, but they fall under heavy regulation, and in many cases it's changing annually. Rules are undefined. There's no legal precedent. And so really for us, it's about this risk-reward continuum. It's probably a slightly more sophisticated view. I think oftentimes angels are going to say, do I like you? Or is today Wednesday? Or did I just sell my beach house? Or, there's a million reasons these other people will invest, and so it may not matter to certain investors.
All right, great. Well, before we wrap up, so this is a big room, and I'm going to miss people. If you're Capital Factory staff, can you raise your hand for me? I'd like to see you all. Okay. So a couple people as we break, if you want to, there's inevitably a big line of people that want to come up and talk and ask questions, which I'm happy to talk to. But there's often other people, if you don't want to wait in line, who can answer the same questions too. So Liz, who was giving the tour, is our community experience manager, and so she helps run a bunch of things in the community here, but in particular also actually knows who gets to sit where and which desks are open and which offices are open and things like that. So if you actually want to work here, then Liz would be a great person to talk to, in addition to others. Arij and Haley are in the back there, and they are two of our venture associates. So they talk to startups that are fundraising all day long. and are dealing with them and helping them figure out who they're going to talk to and investors and a whole bunch of other things. They also help run our accelerator program and our investments. So if you want to talk about working with Capital Factory, they would be great to talk to. And then Grace and Paula, I'll have you fill you in there too. So Grace is one of our startup champions. Paula is our accelerator coordinator. And so a big part of what they do is help the companies that are here get connected into all the different opportunities for investors, for business development, for hiring, things like that. And so they can talk a lot about just both what it means to be here as well as things they see from all those other companies. So great. Let's please give a round of applause to John. Thanks for joining us. And normally the happy hour is upstairs, but I guess now the happy hour is here. And we have, I guess, a bunch of food left over from ATI, because they had an event in here today. That's how things roll at Capital Factory, so thank you for that. What's up with the name tag?
We have name tags for everyone to fill out. You can put a red dot if you're an investor and a green dot if you're an entrepreneur.
So that you can find each other. And then is the robot working? Bar's over here. And there's a bar over here. Cool. The robot has keg taps in it, but I guess not for right now. But cool, awesome. Well, hey, thanks so much for coming, and we'll see you soon.
catering being set up over by the windows. They'll be ready in a few minutes. Thanks.